It is Friday, May 29, 2026, and we are looking at a very tense implied open. The overnight session has locked us into a holding pattern right before the bell. Right now, S&P 500 futures are just marginally green, up 0.1%, while the Nasdaq 100 futures are slipping about 0.3%.
Yeah, on the surface, it looks like a pretty quiet morning, but the pre-market volume underneath is telling a totally different story. We're seeing a massive structural divergence happening right now.
Exactly. I mean, we are skipping the fluff today because we have a huge stack of institutional strategy notes and pre-market flow data to get through. The macro data we're seeing is it's incredibly contradictory.
It really is.
Look at yesterday. April Core PCE inflation printed at 3.3% year over year.
Right, which, is the Fed's preferred gauge because it strips out the food and energy volatility.
And 3.3% is sticky. I mean, that's the fastest pace we've seen in 2.5 years.
Sticky is putting it mildly.
Yeah. And then you pair that heat with the Q1 GDP, which just got revised down to a pretty concerning 1.6%.
Right, so growth is slowing down significantly.
Which is textbook stagflation. I mean, stagflation fears should be sinking the indices right now. If growth is down and inflation is up, holding at these record highs feels like driving a car that's running on fumes but still doing 100 miles per hour. What is actually keeping the market afloat today?
Well, it's the sheer power of what institutional desks are calling ceasefire hopium.
Ceasefire hopium.
Exactly. The market is basically ignoring that terrible domestic macro data because it's being entirely propped up by this massive overnight catalyst. We've got reports of a tentative 60-day U.S. Iran ceasefire agreement.
Okay, so a sudden geopolitical de-escalation.
Right. And you see it immediately in the energy markets. That rumor alone pulled Brent crude oil down to near $93 a barrel this morning.
So the market is pricing in the easing of an energy shock.
Precisely. The theory is, if oil isn't spiking, then secondary inflation pressure.
Like transport costs.
Yeah, exactly. Shipping and transport. If those cool off, it gives the Fed some breathing room. And the broader market just bought that narrative hook, line, and sinker yesterday to push us to those fresh highs.
And we need to be crystal clear with you, the listener, right now. We are looking at strategy notes dealing with the Trump administration, Vice President J.D. Vance, and Iranian leadership. We are absolutely not taking any political sides here, nor are we, endorsing the viewpoints in these institutional notes.
Right, we're just reading the tape.
Exactly, impartially conveying the source material so you can understand how the market is pricing this rumor. Because the context here is critical.
It is, because the 60-day deal is absolutely not finalized. I mean, the ink isn't even close to dry.
No. Treasury Secretary Scott Bessent and Vice President Vance both stated publicly that it's TBD, pending President Trump's official approval.
And Iranian leadership hasn't finalized their terms either. So from an institutional perspective, the strategy notes are just flashing red warning lights everywhere this morning.
They're calling this breakout a classic liquidity trap, right?
Textbook liquidity trap. If you're an active trader looking at your screens right now, you have to realize yesterday's run was built on a completely unsigned geopolitical rumor.
So if the deal collapses, or if the administration just vetoes the memorandum, all of that hopium evaporates.
Instantly. And you'll have a market that is suddenly forced to look directly at that 3.3% inflation and that 1.6% GDP.
Without the comfort blanket of dropping oil prices.
Exactly. The floor would fall out. You'd see a massive wave of long liquidation. So the institutional play right now is to keep position sizes really light, trade the ranges.
Do not chase the gap and go breakout.
Right, not until that ceasefire is actually signed and verified.
Okay, so the broader indices are essentially paralyzed, nervously waiting on this news. But there's one specific sector that is just completely ignoring all this macro anxiety and exploding higher pre-market.
The hardware boom.
The enterprise hardware boom. It is the undisputed king of this Friday. We're seeing capital forcefully rotating this morning. Let's get into the pre-market movers, starting with the staggering numbers out of Dell Technologies, ticker DLL.
Oh man, the physical AI infrastructure demand is just roaring right now.
It is screaming higher. Dell is up over 38% in the pre-market, trading right around $439.10.
38% on a mega cap? Like, that is wild.
Blowout Q1 earnings beat. They hit a record $43.84 billion in revenue. Wall Street was expecting $35.43 billion.
That's not even close.
Not even in the same zip code. And they raised their full-year guidance to over $165 billion.
Which, if we connect this to the macro picture, this is a massive pivot point for the market. For the last couple of years, it's all been speculative AI hype, right?
Yeah, software narrative.
Exactly. But Dell's numbers confirm we are officially past the hype phase. This
Yeah.
is actual, tangible corporate spending, massive enterprise data center refreshes.
Because AI-optimized servers now account for more than a third of Dell's total sales. That's physical metal and silicon being bolted into racks.
It's like laying down the physical fiber optic cables of the 90s internet boom. Corporate America knows if they don't build the concrete foundation of AI, they'll get outcomputed. So they're just writing blank checks.
And we're seeing the sympathy momentum lifting everything in that space. Hewlett Packard Enterprise, ticker HPE, is riding Dell's coattails. They're up more than 20% in early trading. It's like someone found gold and now everyone selling the shovels is suddenly rich.
Great analogy.
So for the active traders listening, let's establish the levels to watch on Dell specifically.
Right, so if you're playing the bull case, $450 is your immediate psychological overhead resistance.
So if opening bell volume pushes it past 450 and it holds,
Then the institutional models point to a blue sky breakout targeting $500. But, you've got to watch the downside risk.
right, what if profit takers step in and that retail momentum cools?
The bear case level is a structural gap fill pullback down to the $340 to $350 range. That is your critical support floor. Break 450, it runs. Get rejected at the bell, expect a very fast slide back down to 350 as overnight money locks in profits.
But, here's the reality check on this whole hardware boom. Corporate budgets are finite. It's a zero-sum game. If a CIO is suddenly writing a $50 million blank check for AI servers, they have to pull that money from somewhere else.
They absolutely do.
You can't just expand your IT budget by 40% when the whole economy is only growing at 1.6%. So let's look at the collateral damage. Who is footing the bill?
It's the software sector.
Yeah.
And the damage there this morning is pretty brutal.
Brutal. Look at SentinelOne, ticker S, premier cybersecurity firm, plunging 20% pre-market, trading all the way down around $14.35.
Yep.
But wait, SentinelOne just posted 21% revenue growth? How does a company grow revenues by a fifth and still get punished with a 20% drop?
It's all about the forward guidance. They issued a really weak Q2 guidance of $290 million, and they announced an 8% workforce reduction.
Wow.
Yeah. Institutions are calling this software starvation.
Unpack that. How exactly is software starving?
So enterprise spend is concentrated so heavily on those massive Dell AI servers that traditional software upgrades are just being delayed or
The
canceled.
hardware is eating the budget.
Right. The CIO says, we have to build this AI data center, so we can't afford to expand cybersecurity right now. Just renew the legacy contract and skip the SentinelOne upgrade.
So mid-tier software is fighting for scraps.
Exactly. Now, for SentinelOne today, there is a technical glimmer of hope. They did finally achieve positive non-GAAP operating income, so if buyers recognize the core business is technically profitable, a squeeze back over $16.50 could stabilize the chart.
But if panic selling continues,
The bear case is a slide down to test multi-year support at $13.50.
and it is not just software feeling the squeeze. The consumer's getting crushed too. The Gap, ticker GAP, is down 15.6% pre-market, trading near $21.10.
Right, and they actually had an EPS beat, right?
They did, earnings per share beat, but top-line revenue completely missed at $3.5 billion. Their Old Navy women's dresses flopped, and total online sales fell 2%.
Which is a classic corporate maneuver right now. Beat earnings by cutting costs, but top-line growth is dead.
And it perfectly mirrors that soft 1.6% GDP figure. The consumer's exhausted, they're pulling back on discretionary spending because of that sticky 3.3% inflation.
So we have a deeply fractured economy. It's crazy. AI hardware is roaring, creating this concentrated wealth. Meanwhile, software budgets are frozen, and the everyday consumer is just tapped out.
Which is why the market is so polarized today. Tech hardware is trying to pull the indices up, but consumer and software sectors are massive lead weights dragging them down.
It's a massive tug of war.
So if you're long the Nasdaq or the S&P right now, you are trusting that the hardware boom can outmuscle the software drag. But to evaluate the actual risk, we have to look at the referee of this tug of war, which is the bond market.
Always the bond market. The macro overlay is dictating everything. Right now, the 10-year Treasury yield has pulled back to 4.46%.
Down from that peak of 4.67% in mid-May.
Exactly, which is a massive tailwind for tech. And the U.S. dollar index, the DXY, is resting around 99.09. So lower yields act as a valuation liftoff for growth equities.
It clears the runway for hardware stocks to fly. But the strategy notes are issuing a very specific conditional warning about something called the pain trade.
Yeah, the present value crush.
Break the mechanics of that down for the listener. How does a bond yield going up directly tank a stock like Dell?
Okay, so it comes down to discounted cash flows. High-flying tech equities are long-duration assets. Their high stock price isn't justified by cash today, it's justified by cash flows projected years into the future.
Right. The market pricing in AI global dominance in, like, 2030?
Exactly. But how do you value a dollar earned in 2030 today? You use a discount rate based heavily on the 10-year Treasury yield, the risk-free rate. If the U.S. government guarantees you a 5% return risk-free, you demand a much higher return to risk your money on Dell.
So if the ceasefire fails and that 10-year yield spikes back toward 5%, the discount rate jumps. Mathematically, the money Dell makes in 2030 is suddenly worth much less today.
Right. Dell could execute perfectly, and their fair value drops instantly just because yields moved. Retail traders chase the AI hype, ignore the risk-free rate, and get trapped.
Valuation multiples violently contract, and while retail panics and sells the bottom, institutions use their dry powder to buy the dip.
That is the pain trade. As long as yields cool, tech bulls have a green light. But if yields trend toward 5%, that momentum trade becomes the pain trade instantly.
So you need to know exactly where the trapdoors are. Let's lay out the precise lines in the sand for today's session.
Let's start with the Nasdaq 100 E-mini futures. Bull resistance is that 30,280 to 30,380 zone, representing yesterday's closing highs.
But the ultimate bear trigger.
The psychological 30,000 handle, specifically down to 29,920. If sellers force a clean break below 29,920, institutional momentum fails, and we get a deep unwind.
And for the S&P 500 E-mini futures.
Bulls need to push past 7,600, but the absolute line in the sand is yesterday's launch pad at 7,520. Break below 7,520, and the structure is highly vulnerable to a terrifying slide down to 7,340.
All right, so to recap this deep dive, we are looking at a market suspended by an unsigned geopolitical ceasefire, with a massive boom in AI hardware masking underlying economic fragility, software starvation, and sticky inflation.
It's a market of absolute extremes today.
It really is. So here is a final provocative thought to chew on before the bell rings. If corporate America is blowing their entire IT budgets building these massive data centers today, literally sacrificing their software upgrades to do it, what happens to the broader economy tomorrow when the servers are finally built and they actually have to figure out how to make all that AI profitable?